All right. Hello, everybody. This is Steve Davis over at Total Wealth Academy. This is the Total Wealth Academy video podcast. As you know, we also have our radio show podcast, but we're just starting into the video and pretty excited about it because I've got some really great guests coming. I'm going to introduce you to some of the top real estate investors in the United States, some of the top sponsors and syndicators. I'm also going to talk to you with mortgage companies, roofers, plumbers, everybody you need on your team will be on here in one way, shape, or form. But today, we're going to talk about hard money loans or bridge loans and why every time I buy a piece of real estate, I use a hard money loan. That's all there is to it. But first, I want to introduce you. Well, Wade Comeaux is with me of Catalyst Funding. Wade, thanks a lot for coming on the show today. I sure appreciate it.
Yeah, I'm very excited to be here and excited you guys are finding a new way to reach out to people. It's good stuff.
Yeah, yeah, I'm excited too. Um, one of my sales pitches is that you want to do business with people who are in the same business as you are. And that sounds like, oh, duh, but it's really not. And what I mean by that is I know people who have CPAs, they're real estate investors, but their CPA's not.
Mm.
And they hire him. He doesn't really know it the way that a competent investor would know it. Or attorneys that have never owned any real estate, things like that. Well, the wonderful thing about Wade is he's actually a real investor. He understands what you're doing. So not only does he help you get loans to buy your real estate, he's taking those same loans and buying real estate for himself as well. So if you would, Wade, tell us a little bit about, well, first off, I think you're holding about 50 houses now.
Yes.
Tell me what got you into that. Why did you start doing that? Were you in corporate America ever?
Yeah, for sure. And I was in traditional lending ever since college. I had an internship and it's funny, I picked the internship not because of a understanding or love of the mortgage industry, but I didn't come from the wealthiest family and it was the one that paid. So I said, sign me up. And it turned out to be, something that I truly enjoyed. It's been my career for, ever since 1996. So, and I'm very happy that I ended up in this category. But anyway, I was in traditional corporate America, going through the ups and downs, especially in the mortgage industry, very cyclical. The economy impacts it, especially interest rates impact it, and worked my way up the ladder. Had to lay off tons of people. In one group, I had 1,500 people, and I had to lay all of them off in a very short fashion. Another
Wow.
time, 600 had to lay them off in a very short fashion. So I wanted to get into something that was more counter cyclical and not so impacted by interest rates in the economy as a whole. So I zeroed in on two things. I wanted to become a real estate investor myself. And then I also knew that I was going to come back to lending, but do it from more of an investment lending perspective because I saw that while home buyers may not buy homes whenever rates go up at the same rate, real estate investors just modify their prices. So I felt that
Yeah.
that was a much more stable lending industry as well. And I set off to build those two businesses starting, I guess this was back in about 2011.
That's incredible that you're up at 50 houses. I mean, and people would think, wow, that must consume all of your time. How are you handling the management of those? Do you manage them yourself or you have a third party?
I did start out managing them myself and had a team that was doing that. Um, but I eventually shifted and candidly, we've sold off some properties. We had a lot more than 50 at one point, but we've kind of moved into different investment categories, not unlike you teach your people that you want to be heavily involved in real estate, but also diversify within real estate. I think that's very
Yes.
important. But we did have a group that was managing that, but I found that I can only manage so many things at a time, and I preferred to go to an expert in the property management space and let them manage those properties and put my energies into things I thought could generate more overall revenue and profit for the different businesses that I manage. And I think it's been a good decision. There are people who are really good in that particular space. They have some economies of scale, and it's been a big positive for us. I moved some of those assets that were managing properties and moved them into other categories in my lending business, for example, and it's been a big overall boost and definitely the right decision.
Well, it's probably safe to say that managing real estate is not your passion. Mortgages are your passion, so that's where you want to spend your time. I'm the
Hmm.
same way. I sold all of my real estate and went completely passive to free me up to teach, which is what I
Hmm.
love to do and what I get excited about. So let's now that these people know that you are a real estate investor and very accomplished at it, let's talk about the correct loan to use when buying rentals and flips. And it's a thing called a hard money loan. And I want to give a quick example because this just stunned me when I first did it. I was buying a property in Houston over off West Green, which is off of I-10 West. And the property was about $200,000. I needed about 170 all in. That was the purchase price, the rehab, the closing costs, and so on. And I got into that deal for $20,000 down using a hard money loan. Well, I did the math, and if I had used a conventional loan, that deal would have been $68,000 out of pocket. 68,000. Why? Because if you use a conventional loan, you've got to put up 20% of that purchase price. You've got to pay for all of the rehab out of your pocket, and you've got to pay all the closing and holding costs out of your pocket as well. Whereas with the hard money loan, you're able to actually give me some of the money for the rehab, and in some cases, all of the money for the rehab, because you've done quite a few zero down deals or just about zero down deals over the last 6 months.
Hmm.
People need to be aware you can't build your portfolio quickly if you're putting $68,000 down on every deal. You need to,
Absolutely.
yeah. So tell them a little bit about your hard money loan program.
Yeah, hard money or private money loans is the national organizations like to call it. They're really the money to purchase and repair distressed real estate. And what's great about it is that it differentiates you from in buyers because in buyers are looking to just get into a home that they love and that qualifies for the financing. So those people are not looking for a discount. So if it's the after repairs value is 200,000, they're going to pay 200,000, right?
Yep.
So you need to be able to have an opportunity to get a discount for the great things about real estate to be available to you. So that means that you need to buy properties in some form of distress. That could be time distress, like they're facing an imminent foreclosure and it needs to close in 7 to 10 days. It could be that it needs repairs that the person can no longer afford. Maybe it needs a new roof. Maybe it needs new foundation. It could be more cosmetic things that don't put it in a position to sell at a strong number, but oftentimes it's mechanical things that would preclude it from qualifying for, FHA, Fannie Freddie, VA loans, etc. So those homes that are disrepair are perfect for hard money loans because we're able to give the money to purchase and repair. And using that same property you're talking about, say it's a $200,000 property and you're buying it for 120,000 and you need to put 30,000 in repairs. It takes you up to 75% of the after repairs value. And our company finances 75%. So the beautiful thing about that, you mentioned earlier, some no money out of pocket deals. If you are able to get to that 75% number or below, you might even be able to roll in closing costs and come to closing with no money out of pocket. Um, and the important thing about these hard money loans is that they're looking at the after repairs value. So it's a subject to repairs appraisal rather than an as is appraisal like you would get on every type of stabilized loan product out there. Fannie Freddie, VA, USDA, any of those loan products are going to look at that as is appraisal. Then to your point, you're going to have to bring 20% of your own money, especially on a non-owner occupied property. And the numbers just don't work out to where you can grow your portfolio with velocity. Conversely, this other product is going to be 75% of that after repairs value. You're going to give your lender what's called a scope of work or repair budget. You're going to define the things that need to be done to get to your eventual exit strategy, whether that be selling the property, or in this case, we're talking about refinancing to do a buy and hold. And the appraiser is going to look at the vision you have painted. He's going to look at the scope of work you provided and said, whenever this property is completed with the scope of work, it will look like these comps. And that's where you can really get that delta, that after repairs value, where we lend at 75%.
Yeah, and if you can get it at 75%, that again, I know he said it, I said it, that's a zero down deal. If you
Yeah,
can purchase it, rehab it, and pay your closing costs at 75 cents on the dollar, that's a zero down deal. And that is not, you can't run your business off of zero down deals, but they do occur. People do get lucky and get them.
sure.
Tell me a little bit about pre-qualification. How can somebody get pre-qualified for these loans?
Yeah, it's a pretty easy process, but there are differences in the companies that you might work with. So there are a lot of hard money or private money lenders that only provide the money to purchase and repair distressed real estate. At Catalyst, we're unique in that we provide not only the hard money loans, but a wide variety of long-term loans, including conventional refis or what are called debt service coverage ratio or DSCR loans. And if you work with a company that does both, you can not only get qualified for the hard money loan, you can also get pre-qualified for the exit strategy, which makes it very good whenever you're working with a mentor at Total Wealth Academy, because you can talk about what your interest rates are estimated to be whenever you refi on the backside, so they can help you calculate your cash flow and your cash on cash returns. But if you can get pre-qualified for both, that's an ideal situation. So it's a kind of a couple of steps. With Catalyst, we can actually get you pre-approved based on your a soft credit pool, which is an important thing to consider because you always want to keep your FICO score in mind because that will really impact your long-term interest rates. So we can get you pre-approved based on that. A pre-approval means that we're only looking at what you have stated to be your income and assets. Now, whenever you come back and give us your full documentation, we can transition that to a pre-qualification, which means what we've actually looked at, your W-2s, your tax returns to get you qualified for that long-term loan. But the pre-approval process can be in 24 hours typically for us, very easy, soft credit pull. And then the pre-qualification will take another maybe 24 hours from the time you get us those necessary documents to make sure we can get you qualified for the best possible long-term product. Now, if you don't want to go through the trouble of providing all those docs, you just want to flip properties, then you don't need to provide anything other than your asset docs, easy 24 hours. And if you don't want to send in your income docs, you can qualify for these DSCR no income doc loans, which are fantastic. The rates are very attractive right now compared to conventional loans. And a lot of the investors at Total Wealth Academy are using those DSCR loans because they're so much easier. You get a 30-year fixed rate, and it's just super attractive because the pricing is very, very in line with what you're going to see on those conventional loans.
Well, I think that I skipped something. We were talking about using the hard money loans, and then you just mentioned about refinancing that. When you're doing a rental, you use the hard money loan to purchase the property,
Mm-hmm.
but as soon as the rehab is complete, you refinance it into conventional 30-year fixed as a rule.
Yes.
So it's a two-step process for those of you listening for the first time. A lot of people have a concern that hard money loans are high interest rate, but I don't care because it keeps my down payment low and I only use them for 2, 3, 4 months before I'm refinancing into a permanent loan with a low interest rate.
Right.
So keep that in mind, people. You don't use these, if you're flipping it, you'll probably leave it in the hard money loan until you flip it. But if you're going to lease it out, then you're going to move it into a conventional permanent financing. Next question is exactly, well, I kind of mentioned it. A lot of people are afraid of the hard money loan because of the high interest rate, but you actually have a promotion right now where you're doing a lower interest rate to start off.
Yeah, we've always had that program. It's just a a little bit more attractive now because rates have come down a little bit, but we are offering 9.49 as of December of 2025. That could go up or down over time depending on the market, but it's very attractive because a lot of our investors that are focused and they have a good team, the type of team that you can build with the access to the Total Wealth Academy vendors that Steve and his team have really curated that are fantastic. If you work with good contractors, good foundation people, et cetera, you can get in and out of that property in 60 days and maybe never be beyond that 9.49 rate. Now, it does adjust after 60 days, but if you're really on it and you have a good team, we see a lot of our borrowers get refinanced before the rate ever adjusts.
Yeah, that's excellent. That's a great opportunity, especially like you said, most deals, they're 5, 6 weeks. So you're under 2 months and you're out of the hard money loan and into that conventional loan.
So
Um,
one
one of
quick
the
rule
other
of thumb I was going to give to
Go
people
ahead.
that if you're looking at your rehab budget, most of the good contractors out there can do about $1,000 a day. And the average deal that we're seeing in the current market in the greater Texas area, probably like let's say a $40,000 rehab. So that's probably a good estimate of 40, 45 days. So you can totally get that refied out before the 60 days is up.
Yeah, absolutely. And that's the way people want to do it. You want to get out of that hard money loan as quickly as possible, get into your conventional, and then move on down the road for your next deal.
Right.
So tell me a little bit about the type of deals that you're doing and you're seeing right now. You have members that are doing not just one deal, but multiple deals. You have a story about one of those people?
Sure. We had one person who did about 14 deals in 2025 and have refinanced a lot of them. They're out of the majority of those. So that's kind of like a high end story. But we have other people who do three, four a year, and they've been doing that for the better part of a decade. So um, I think that it's important that you have a way in which to find these off market deals. And that's one thing that you and your team do a great job of is presenting these off market opportunities. But once you do that, you start to develop a strategy of financing, because you have up to 10 Fannie Freddie deals that you can do. But after that, moving to DSCR is a very good viable option so that you don't have to feel that just because conventional loans cap out at 10, you can only add 10 rental properties. There are a lot of options that help you go beyond that number.
Yeah, I'm glad you brought that up because that was my next question. Is there a limit to the number of rent houses you can own? And there really isn't.
No.
We've had members with as many as 123 houses, and I believe about 70 of them or 80 of them had mortgages.
Yeah.
So there is no limit. The other thing I tell people, and Wade, you can correct me on this, when you go get your pre-approval letter, you tell them, hey, you're pre-approved for $300,000 or $500,000. And people have a tendency to go, well, if they're $250,000 houses and I'm approved for 500,000, then I can only buy two houses. But that's not the case, is it? Because as soon as you buy those two houses, you now have that additional rental income.
Yeah, that's a great point, Steve. So when you're looking at conventional loans, whenever you do uh, that first transaction, if you qualify for the first one, as long as you have deals that cash flow at the numbers I'll talk about in a minute, you can add up to 10. And that's because these rentals should be in large part cash flowing. So what conventional loans do is they're going to take 75% of the rents. So if you have 2,000 in rents as example, they're going to allow you to count 1,500 towards offsetting the principal, interest, taxes, insurance, and homeowners association dues. So if that number PITIA is below 1,500, then you are at least breaking even. And if it's below 1,500 on this calculation, then you will get extra money towards qualifying your debt to income ratio, right? So most of the deals are going to be in that range, where at 75%, they're at least going to be breaking even on that number. And some of them will even cash flow in that evaluation. So as long as you're picking the right deals, if you qualify for one rental, you'll qualify for 10. And then after you get beyond that 10, you can go to DSCR. Now, some people may not qualify for that first conventional deal. And the great thing about DSCR loans is they're not evaluating your personal ability to pay a mortgage. they're evaluating the property's ability to pay that mortgage. So often a target for DSCR loans would be like a 1.25, but we have some products that go down to a 1 DSCR that still have very attractive rates. And then we actually have some no ratio DSCR loans where even if you don't have a positive cash flow, you can still qualify. And those are ideal for like those Airbnb, VRBO properties that may be a little bit higher on the price point and still can qualify for these excellent DSCR products.
This brings up a question that's kind of off the subject, but is it FHA now that doesn't even check credit?
No, they still check credit, but they have lower standards. Like there's a proven ability to pay on all loans after the great financial crisis. That's a little bit different. So you do have a FICO evaluation, but they have lowered the standards a little bit lately in some of those categories. And then they also instituted some proven ability to pay. Now that can be bank statements. There are bank statement loans. So on an owner occupied property, by the way, Catalyst also offers those through our partnership with Blueprint. But if you are wanting to get qualified for an owner occupied loan and you write off everything as a business owner, there still may be bank statement loans that can document your income and still get you qualified.
Wow. So there's really no excuse for people not to get out there. And the other thing, and we do that market update once in a while together, which
Yeah,
I appreciate. Um, it's really turning into a buyer's market. There really are a lot of good deals out there right now. And it's shocking to me because we're seeing fewer people coming through the doors to learn this stuff when this is the time to be learning this stuff and getting out there and taking advantage of the market. And I think it's going to become even more, again, my opinion, it's going to become even more of a buyer's market before it turns around. And there are going to be tremendous deals coming in the next few months, the next year. It's time to get going. What are your thoughts on that?
I completely agree. It's a more difficult market to flip now than it certainly was back during the COVID era when
Yeah.
rates are super low. But people are still doing it. We just had one borrower who's doing a $660,000 flip, and those are numbers that might make me nervous for a new investor. But this person's done like 10 different flips with us, and she and her husband crush it every single time. They're just really good at it. They put out a fantastic product. They aren't even buying super deep, but they control their cost on the rehab because he's a general contractor as well. And then
Mm.
they just put out a fantastic product, and it sells really fast, and it sells at or above what the market will bear. So, but those people are not as common right now. Steve, you and I both know there are not as many
Yeah.
successful flippers at the moment. But the people who are really crushing it are the people who made the same decisions back in the same type of people who made those decisions back during the great financial crisis when everybody was saying home prices are down so much, you'd be crazy to buy right now. The market is unstable. And those people crushed it. And candidly, I got in on the tail end of that back in 2011 and still have done really well with those properties. It's the same, it's not as uh, extreme right now, but it's the same environment now. You hear people saying it's the worst time to invest in real estate. You can't sell a house, you can't flip it. There's nothing you can do there. And while you can, to a certain extent, still flip properties if you have the right game plan, what you can definitely do in a buyer's market is buy rentals. This is the time to buy rentals. There's no doubt about that.
Yeah. And the properties are on sale, deeply discounted.
Mhm.
There's tons of great contractors out there. We have ours at Total Wealth Academy for our members, but there's team players that can get it done, like you said, $1,000 a day, get it done in a few weeks, get it in a conventional loan, then get out there and buy your next one and
Right.
just cookie cutter it. What's that? The BRRR
Yeah.
strategy.
The Burr method. Yeah.
So, what other types of loans do you do? Do you do any types of commercial loans?
We do not, these are all depending on who you speak with, technically commercial loans, but we don't provide financing on anything above single family 1 to 4 properties. We had dabbled in that at times, and it's just not a great fit for us, our level of expertise and what we're
Gotcha.
really passionate about. We really want to be the absolute best lender in the private slash hard money space and in the refi space for the single family 1 to 4. And we also want to be excellent if one of our clients wants to purchase their primary residence. We just got someone qualified the other day for a $1.6 million purchase loan for their primary
Wow.
residence. Like, we can do all of those things. And we really want to be an expert in that space. I know you have some other lenders on your team who are really good in that commercial or that multifamily space. We just want to be excellent at this one category.
Okay. And how can people get in touch with you?
Uh, the best way to find us is at catalystfdg.com. And then also you can reach us at, let me just make sure I got the number right, our sales number. Give me 1 second. But if you look at, you can either Google us at Catalyst Funding, or you can type in catalystfunding.com or catalystfdg.com. And then the phone number, I'll have it here in just a sec. I should have been prepared for this. You always do a good job of getting us out to everybody, but I was not as prepared. Let's see. The best phone number to reach us at is at 281
Okay. And we will have the links and the phone number below this podcast as well. Well, Wade, that's about as much time as I want to take on this. I sure appreciate you coming on here. Great information. Be aware that Wade has helped dozens, if not hundreds, of our members buy real estate. He can help you do it too. So thanks for watching, everybody. Have a great rest of your day.
Thanks, Stephen.
Thank
Thanks,
you.
everybody. Bye bye.